Welcome to the Daily Update Podcast, where I'll go over the action in the market for Friday, December 5th, and we'll see how things look for Monday, December 8th. The S&P 500 opened with early strength, briefly pushing above both R1 at 68.73 and R2 at 68.90. However, the momentum faded quickly. The index surrendered most of its intraday gains, traded sideways for much of the session, and ultimately closed up just 0.19% at the 68.70 level. Volume remains below average but did pick up from previous sessions. Despite the lackluster price action, the broader tone remains bullish across all three timeframes. The S&P is barely trending, grinding an advance rather than a powerful trending rally, but there has been no meaningful breakdown either, and the internals are still largely constructive. Key positives supporting the bullish case: over the last couple of trading sessions, we were dealing with the 68.60 level, and that has been cleared. Market breadth is improving. The advanced decline oscillator is pushing extreme into positive territory, and new highs continue to expand. Sentiment is largely recovered from being deeply pessimistic earlier seen in November. Most momentum indicators are either positive or turning positive. Two of the three smart money indicators still remain positive. Equity ETF inflows are strong, systematic selling pressure has eased, and earnings estimates are being revised higher. Finally, next week's Fed rate cut is fully priced in and widely viewed as a done deal. That said, there are several yellow flags worth monitoring. Growth continues to underperform value, particularly in the large and mid-cap segments. Leadership from traditional growth sector remains sporadic at best. There is a confirmed Hindenburg omen that remains in the background, and there's an unconfirmed ZWAG NYSE breadth thrust, which looks unlikely to be confirmed after Friday's session. The S&P is more than 10% above its 200-day moving average, which statistically has suggested the index is overextended. The 10-year Treasury yield has been climbing and is now at 4.14%, up from the 3.99% seen on the day before Thanksgiving. Finally, the Chaikin oscillator, one of the smart money indicators, has turned negative. On the economic front, core PCE came in cooler than expected at up 0.2% month over month versus a forecast of being up 0.3%, and personal spending was softer than anticipated. The data was mixed but did nothing to alter the December rate cut expectations. Looking at the sectors, communication was the leader on Friday, lifted by strength in Google and Meta. Small caps and the Russell 2000 gave back a portion of Thursday's new all-time high. Semiconductors and mega-cap tech were mostly flat to slightly lower. Netflix's notable weakness may be tied to rumors of a potential Warner Brothers Discovery acquisition. Looking ahead to Monday, December 8th, there are no major economic releases scheduled. The next Fed meeting will begin on Tuesday, but they'll make their announcement on Wednesday, and there is the anticipation of a quarter-point rate cut. December 8th itself carries positive seasonality, and December as a whole tends to strengthen in the back half of the month. We are looking at overhead resistance at the 69 to 69.50 level, as indicated by the Gamma Exposure Index. Nearest meaningful support is at the round number of 6,800. The S&P is only 0.3% away from a fresh all-time closing high. In conclusion, the low conviction grind higher continues. The S&P does look tired in some instances and overextended, but refuses to break down. The bulls remain in control on all time frames, yet leadership is narrow and conviction is lacking. A decisive push above the 6,900 to 6,950 level, accompanied by renewed growth leadership, would reinvigorate the uptrend. Continued chopping or persistent growth underperformance keep the risk of a deeper pullback on the table. Thank you very much, and I will talk to you in the next podcast.